Sanjeev Prasad is with us, Managing Director and Co-Head in Kotak Institutional Equities. Sanjeev, good morning. Great to have you back on the program. Prashant here. What has been your assessment of things, Sanjeev, on the recovery that we have seen? Do you think it is sustainable, underlying in terms of what your interaction and your team's interaction with corporates, companies? Are things turning at the margin a little bit? RBI seems to be focused on, doing what it can to revive growth. I don't know if the fiscal thing will happen. Tax cuts, of course, will take effect. But what's your overall sense?
Okay, so I think we're still, I would say, somewhat cautious on the market. We have seen some recovery, but that's more led by the banks, actually. It's not as if the rest of the market has really participated in the recovery. The market is up roughly about 5% in the last month or so. But at the same time, we are also seeing earnings downgrades. So we've seen about 2% earnings downgrades in the last fortnight, more linked to cuts in the consumer sector space, in IT services, and also oil, gas, and consumer fuels on lower oil prices. So as far as the fundamentals are concerned, nothing much has changed. If anything, on the earning numbers, we have seen some downgrades. Coming to the economy and the company's commentary, I see nothing much has changed, I would say, since we last spoke. There's some talk of rural recovery, but nothing beyond that. Urban is still looking very slow based on the commentary from the companies. If you look at the investment part, still looks really slow. You have seen the numbers for the government for the first 11 months, basically flat on a YOY basis. So no real excitement as far as the CapEx cycle is concerned from the government side. Housing cycle, we'll have to wait and see. Things have been good for the last 3-4 years, but I think given the big increase in prices in the last year or so, you could possibly see some slowdown. And we are not seeing any real recovery in the private caps part. And we put out a big report on the whole investment cycle and somewhat cautious view over there. So both on the consumption investment side, we're not seeing any real recovery, I would say. So that's where we are. The market is not cheap enough, for us to get terribly excited. Market not super expensive. Also, if I look at the large cap Nifty 50 index, about 21 times, not too bad, I would say. But on an individual basis, it's a struggle to find ideas. Most consumer-related sectors are still fairly expensive. Investment stocks are still expensive, especially in the context of the slowdown that we are seeing in government spending and no recovery on the private capex part. So I would say no real excitement at this point in time.
Got that. Sanjeev, hi. So I just want to understand how you're thinking about financials right now. Relatively, I think large financials is something that you've still liked. But the issue is, I was just looking at the Nifty Financial Services Index. It's already almost back at the all-time high because a lot of money has been going back on the BFSI side. Even the Nifty Bank, I'm just checking numbers. Let's get these indices up on the screen if we can. The Nifty Bank is also 11.5% to 12% off the lows. And now it's about 5% away from the all-time highs. That's Nifty Bank today. Let's pull up longer-term charts if we can. This index is 5% away from the peak. And the Nifty Financial Services Index is practically back at the all-time high. So, Sanjeev, the question is that then what's really left to play? Because there's still some concern about a pickup in credit offtake and whether growth can come back. Your thoughts?
So if you break down the entire financial services into the banks, NBFCs, and insurance, as far as the banks are concerned, again, you have to break it down between the frontline private banks, the second-tier private banks, and the PSU banks in general. The valuations still seem okay. I mean, if you look at the private banks, the frontline ones, yes, they have gone up. Maybe not much more scope of relating from where we are. If you look at an ICICI Bank adjusted for the value of a non-bank business, it's about 2.5 times. So maybe the scope for relating is limited, but the bank is doing exceedingly well, checking all the boxes, delivering about 15% ROE. So at best, you can hope, for maybe, if not some relating, ROE-linked returns from the stock. And I would think maybe HDFC Bank in a similar boat as of now, given, again, the relating which has happened over there. Look at the tier 2 banks, they have some challenges over there. If you look at an Axis, for example, 1.7 times price to book on a 12-month forward basis, possibly some scope of rating. if some of the concerns which have, risen for Axis also, unfortunately, as part of whatever we have seen in IndusInd Bank, once hopefully those concerns get addressed, maybe you could see some re-rating over there. PSU banks still look interesting, still cheap, 0.8 to 0.9 times most of them, barring SBI. And I think they could probably hold up better in this environment, assuming the market is okay. If the market comes off, then all bets are off in that case. But given that they don't have much of exposure to, let's say, the MFI loan book, which has what has plagued some of the small finance banks and MFI and NBFCs, and they would probably be better off in the rate cut cycle which we have entered, given the fact that more than slightly 50% of the loan book is MCLR loans, which don't get affected that much. So they may be in a slightly better position compared to the private banks on the NIM part. On the asset quality part, yes, there are still concerns out there. Hopefully next 1 or 2 quarters, if we don't see anything bad coming out on the credit cycle as far as the PSU banks are concerned, maybe there is some scope of rating in the multiples over there. So that's as far as banks are concerned. NBFCs have seen a terrific run linked to the rate cut cycle. Valuation looking reasonably full, I would say. We have been quite positive on the Bajaj, Twin, Shriram, etc. All of them have done quite well. Maybe not much scope for rating, but the companies can deliver quite solid numbers. On the insurance, valuations are still quite attractive. Some of the regulatory / policy-led concerns seem to have finally been addressed. Hopefully nothing more negative coming over there. And lastly, the capital marketplace, again, they will more depend on what's happening in the market, right? They're entirely exposed to the whims and fancies of the market. Valuations are, high over there, but I guess people are taking a longer-term call despite the short-term blip that you are seeing in trading volumes, etc.
Hi, Sanjeev. So you're sounding fairly cautious, but you're still working with nifty EPS growth of around 13-14% for the next 2 fiscals. Is there a downside risk even to that?
I would assume so. I think there's some downside risk in autos for sure, given what is happening on the global side, and even domestic demand environment is not looking very good, especially on the four-wheeler side. So possibly you could see some downgrades, and we'll have to anyway wait and see, how this whole tariff issue plays out, how much of the Indian government open to further competition from, imports, etc. And what does it mean for the domestic OEM companies? So that's one risk still out there. I think the margins are still on the higher side over there, and given the run-up in raw material prices, both aluminum and steel off late, you could possibly see some margin pressures in a weakish demand environment. Otherwise the companies could have been in a position to pass it on, but it will be slightly challenging given the current environment. I think consumer names mostly would probably still see some downgrades. The demand environment is still looking fairly weakish. And lastly, coming to the IT sector, the hopes of recovery keep getting postponed. We have seen some earning downgrades over there. But if things continue the way they are, in the sense that companies themselves not in a position to take too many decisions, and I say companies, I'm talking about the customers of the IT services companies, given the uncertainty which has been created because of the policies of the Trump administration, a lot of decision making could possibly get postponed. Yeah, so possibly some downgrades there too. Yeah, so 14%. That's what we are working with currently, but I don't rule out, 1 to 3% over the next 1 or 2 quarters. This quarter will give you some more sense in terms of, how things are looking, what kind of management commentary come. But the earnings are not the problem. The problem is the valuations. You're looking on a bottom-up basis, sector by sector, stock by stock. In most cases, valuations are higher than pre-pandemic levels, and that's where I struggle, honestly. Given the fact that global interest rates are meaningfully higher compared to pre-pandemic levels. Risks have definitely gone up, given geopolitical issues and so on and so forth. And 3, disruption risks across sectors and companies have gone up meaningfully. So to give the same multiples, higher multiples versus pre-pandemic levels for lower growth and, far higher uncertainty with respect to cash flows, likely lower profitability, that simply doesn't gel with me.
I know, absolutely. Point taken. Sanjeev, I'm not arguing that maybe if global interest rates come down, as the US administration very clearly wants, the focus is on bringing down interest rates, devaluing the dollar, etc. It can't be a catalyst or an argument to buy something in terms of stocks But it is a factor in the overall scheme of things. You said, I mean, interest rates are far higher than pre-pandemic levels. At the margin, how much of that is a factor when you look at valuations?
Should be logically, right? Ultimately you're working on some cost of equity, and if your risk-free rate is higher, logically your cost of equity should be higher. But these are all theoretical concepts. People can ignore it, but it's a fact of life, right? Your bond yields are much higher. Your opportunity cost is a lot better. And the bigger issue is, risks are far higher now compared to what they used to be. If you look at any sector, nice, market structure, 2-3 players, not much of competition, but across sectors that has changed dramatically now. A lot more competition. So A, volume growth will, will split across more number of players, and B, profitability could be under pressure. And we are seeing that in several sectors, right? More and more announcements coming from companies to enter that sector. Wherever you're seeing higher levels of profitability or returns, companies are, making plans to enter those sectors. So those high levels of profitability will not sustain. So it is pointless, using the same framework as what we have used in the past. Everything has changed, right? So your risk-free rate is higher, your risk premium should be higher given far higher levels of disruption and macro risk. So logically, the cost of equity is higher, multiples should be lower to factor in the extra, risk that one is carrying currently. But yeah, I guess, theoretical argument aside, market has its own way of looking at things. But you are seeing that challenges coming through ultimately, right? You have seen massive derating in multiples of several stocks. You have seen several sectors stock not doing it for the last 2-3 years now. So yeah, so some of these, concerns which we've been highlighting for not, today, we have been highlighting these points for the last 3-4 years. They're eventually playing out. More competition is a given now across sectors. That seems to be a norm. Profitability is coming under pressure. Returns are coming under pressure. Now to the market to decide how to, treat.
Sanjeev,
Yes.
Sanjeev, you have highlighted quite a few concerns, but do you think on the headline index, the downside risk could be limited at least, give and take everything?
Yeah, I mean, given the composition of the Nifty 50 index, yeah, the downside may not be 5-7%, I would think. Again, these are assuming normal situation, but we're not living in a normal time, so keep that, risk factor in mind, of course.
All right, Sanjeev, we'll leave it there. You've published a big anchor report around the CRDMO opportunity in pharmaceuticals, and next time you're on, we'll kind of sort of deep dive into that. But thank you very much for joining us with that perspective on markets. Nigel.